Hi, my name's Ed Wallis. I'm here with Nick Whitehead, an audit manager. We're here to talk about cryptocurrency and the financial reporting implications here in the UK. Hopefully Nick is going to give us a brief overview of that now. So in terms of the companies that we've seen so far, what kind of approach have we seen them taking, and what is their general sort of purpose for cryptocurrency or crypto assets at all?
So certainly the clients I've dealt with, the advice that they've been given has always been that common sense approach of what do you use them for, and then the answer has almost invariably, with the exception of a couple of special circumstances, it's fallen into either the bracket of intangible assets or inventory, stock. And I think the distinguishment between those two answers is relatively straightforward. And I think from my point of view, it's always start with inventory. And the question there is always, what are you doing with that crypto asset? Are you buying it when the price is low with the intention of selling when the price is high to make profits? At that point, you're in the realms of buying and selling for profit making, which is kind of fundamentally what any sale of goods company is looking to do. And so at that point, you would be required to follow the inventory accounting rules. You'd have to keep track of every single crypto purchase being made. And then kind of more importantly, you're looking at year end, you're looking at what that cost versus net realizable value is. And I think with the volatility, certainly that we're seeing at the moment with Bitcoin prices and the wider currencies available, prices can drop in an instant. And so you'd have to do a lot of work at each period end to have a look at whether cost is actually lower than net realizable value, because all it takes is a 1 day dip at year end and you're looking at some potentially significant impairments. So I'd say with that policy, you're looking at impairment reviews being very, very important. More importantly, you're also looking at all of your gains and losses flowing through the P&L directly, and there may well be some tax implications with that. So if that is what you are using the assets for, it's unavoidable. I think that is the right answer. While there's nothing else that is kind of specifically designed for it, I think that's the route you'd have to take.
I think a lot of people might be surprised to sort of see it not defined as cash. I mean, obviously in this instance, inventory is absolutely the right way that you say, with people holding it for buy, sell. But it might seem strange to people that it's not held as cash. Can you give an overview of why that is?
Quite simply, the only reason it's not being recognized as cash, or people haven't been able to conclude that, is that one of the only things that the policymakers have said is, in our opinion, cryptocurrency does not meet the definition of cash. And so quite quickly that was ruled out when this became slightly more mainstream, slightly more common. And that's both under the IFRS treatment and under UK GAAP. Both policymakers have overtly said that they would not consider cryptocurrency to meet the definition of cash. So in those situations where you're buying, selling for profit and you've got inventory, where you're looking at something or a business that uses it more as cash, as the similar sort of use to the business as cash, we're looking at what else we can recognize it as. And the predominantly more common guidance, particularly from a lot of the kind of big four, top 10 firms that have got specialist teams looking at this, the most common application's been intangible assets. I think for quite an obvious reason that cryptocurrencies are intangible. And that was really one of the only other financial reporting areas that I think made sense. What are the implications of that? I guess you're looking at a similar tracking requirement to keep a track on every single transaction you're making, because you need to be recording things at cost. But what it really does offer, particularly under IFRS, is the option to adopt the revaluation method, which might make life easier as far as the ongoing kind of tracking requirements that you'd be facing. under the revaluation method, you'd be able to keep a track on your cost, but then periodically revalue up or down, and you wouldn't have to show those revaluations through the P&L, which I think is a potentially really important factor in the financial reporting, because again, it might be cleaner from a tax position, but if it's not the fundamental driver of your profits and losses for the business, then having those gains and losses can really throw off what your P&L looks like. And I think having the opportunity to put that through other comprehensive income and show it through reserves really helps keep that P&L tidy, but more importantly, showing like a true and fair reflection of the profits and losses of the companies, and keeps the kind of intangible flows of the gains and losses of those crypto assets kind of separate, which I think is a nice solution for now, where that is the purpose of the crypto within your business.
Sure. So with intangible assets, obviously one of the things that you do need to do is demonstrate that you're going to have future economic benefit from an intangible asset. How can it come with all of the volatility in the market and that challenge? How can a company sort of demonstrate that to an auditor or in their financial statements?
Typically, if you're holding crypto assets that are not being bought and sold for the sole purpose of profits, and therefore under the inventory method, the chances are you have that for a reason that's probably going to be easily demonstrated for the purpose of profits. For example, probably the most common application I've seen from clients in the crypto world has been a form of trading platform. There's some pretty big names out there that certainly came particularly mainstream during that big 2017 price bubble, when everyone was looking at the easiest way to get online and buy a little bit for themselves and make some quick money. If holding crypto enables you to run that platform and provide that platform to your customers, that's then going to provide you with fees or margins on those trades, then I think, for example, that would be a really easy way to demonstrate that the holding of those assets is going to create future economic benefits. And so I would say that if the crypto asset is material in your trial balance, and therefore your auditors are asking to prove that future economic benefit, the chances are it's going to be very easy to prove just based on your business plan and what the very nature of what you're doing is. I think if you're having question marks over your ability to prove that, you're probably having question marks over a few other things to do with why you're holding that crypto asset. And so that might be a can of worms that might not be worth opening during an audit. You should probably get ahead of that before the audit starts.
Sure, definitely. And then obviously, we sort of covered the two options for inventory and intangible assets. And whilst it's generally accepted that it doesn't meet the definition of cash, how does it sit within the financial instruments policy and the treatment of that? Is there any scope within financial instruments for this to meet that definition?
I think the short answer is no. I think I really struggle to see where the use of crypto would be better placed in just a basic or a non-basic financial instrument policy that would be more appropriate than the intangible or inventory option that we already discussed. But don't get me wrong, there probably are some really specific reasons. I did have one client that I worked with that started with financial instruments as their recognition approach, but that was predominantly due to some intercompany arrangements that meant the genuine ownership position of the assets was slightly more questionable due to some agreements between their kind of parent company and themselves. And so, yeah, I think I can't really see a financial instrument solution. I think inventory or intangible assets is much safer.
Okay. And when it comes to choosing what accounting policy you might want to apply, I think it's quite clear from our conversation here that a bog standard inventory or intangibles policy just isn't going to cut it. So what kind of approaches have you seen people take, and how detailed do we need to be in the financial statements in terms of making those sorts of disclosures?
Well, I'd say the best way to look at it, or the way I look at this, is definitely that the accounting policy is your biggest ally through all of this. When you're in a world that hasn't given you a tailored solution to how to approach this, writing down how you're approaching this in the financial statements for your stakeholders and users is a natural place to start. Using a boilerplate inventory or intangible asset accounting policy is probably never going to be appropriate. And so I think really calling out how you have approached the recognition within that accounting policy is the only recommendation that we can make. Exactly what to say in that policy, I don't think I could really provide any information on that now generically, because it really should be completely tailored to your business. And so I would definitely just seek advice, whether it's internally or with people like us who can talk it through and try and help you provide something completely tailored, but at the same time minimal enough that you're not completely giving away all your secrets.
Okay, good. I think that's probably given people enough to think about. There's obviously two clear choices to begin with, and then as you go down one or the other, you get the opportunity to tailor that to what best suits your business. Is there anything else that you'd add for people making this choice from the outset, or trying to get into the crypto world and start pushing these sorts of things through their business?
I think the best advice I could give would be think about it early, as early as possible, really, as far as certainly your annual reporting goes. Talk to people, whether it's other people in the industry that you deal with, whether it's professional advisors like us, looking at your competitors' financial statements if they're publicly available. Knowledge is power. Information and examples are only going to help you. And then, I think be open to tailoring things as much as possible and putting potentially a little bit more information in your financial statements than you might be used to, but it's going to protect you, it's going to protect your stakeholders.
Okay, great. Well, thanks for that summary, Nick. I think it's been good to understand a little bit more, certainly from my perspective, and run through those items with you. I think if anyone does want to get in touch and speak to us about this sort of thing, then we're open to that, and we can certainly help with financial reporting in relation to cryptocurrencies.
Awesome, thanks.